Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in studio today for this podcast. We got all kinds of news events that are happening here in the next few minutes. Got a bunch of data points here to go over with everybody to set you up for success for the remainder of earnings season here. So we're right in the middle of all that. And can't wait to get this thing started, but anything that we're getting from viewers this morning that we want to start with, or do we want to just jump right into the meat and potatoes of all this data that we have here?
I think we should just jump right into it.
Yeah, I like it. You got Jerome Powell talking at noon today, which is roughly in 53 minutes.
Eastern Standard Time.
Yeah. So
Got
everything.
your Fed bingo card ready.
That's exactly right. You know, it's going to be an event, no doubt. It's definitely going to move the markets. The markets are basically flat, slightly down across all major averages as I'm delivering this podcast to everyone here today. Know that there's a ton of headline risk, and I'll get to that in just a second, but I wanted to take a step back. I wrote about this on our weekly blog that we do. We post it out on our website, shepherdwm.com. Try to do one every Friday. It doesn't work out that way every single Friday, but last week we got some important information regarding inflation. So the CPI report for September was released, and it was largely in line with consensus expectations. So markets were looking for 0.3% for the month, and that's exactly where core CPI inflation came in. Now, the headline CPI was actually a little higher than that, a little higher than consensus thought by 0.1%. But that was directly due to gasoline price spikes that have happened over the prior, call it 6 to 8 weeks. In the summertime, which is the heavy peak travel season for most individuals here, at least in the United States, and largely around the globe. So that wasn't a shock by any means. But the core number, which strips out food prices and energy prices, people ask me why the Fed strips that out. I know that we all have to pay for it. That's why the question exists. But the reason why they take it out is because you could raise, interest rates to infinity. It's not going to affect the price of oil, really, because it's based on production, right?
Right, and largely controlled by OPEC.
Exactly.
Yeah.
So, again, that's why the Fed, it's not that they don't care about the price you pay for gasoline. It's just that they can't control that with monetary policy. So that's just for everybody that has that question out there. So the core is what they can control to some extent with monetary policy. Works with the lag effect, of course. And we're starting to feel that lag effect slowing down certain things, but not all things by any means. So core inflation came right in line. Now, this is unbelievable to me that nobody was talking about this during the CPI report. And I get that there was a ton of geopolitical headline news that everybody pivoted to.
Yeah.
It was like, hey, CPI came in line. Market takes up, for about an hour, and then the cameras turn to, hey, there's a conflict going on in Israel. How terrible that is. So I'll have something to say about that in just a second, but nobody talked about this at all. So the presentation of the data was terrible, in my opinion. The news does what the news does, which is, get your attention in any way, shape, or form they can. I think that they understand the human being better than pretty much any other industry, given that they look at humans' emotions. We're extremely emotional beings. We're hardwired with these things called fear and greed. And thanks to studies from behavioral finance field, we've learned a lot about how human beings make decisions and process information that's extremely stressful. And ultimately, my job is to remove emotions from making investment decisions. So I spend a lot of time understanding this data as well. And I think the news understands that human beings, based on this study called behavioral finance, we've learned that we feel losses twice as much as we feel good about making money.
Oh, yeah.
So we're risk averse by nature. Is really what that study is telling us. When something that we perceive as negative or could hurt us in the form of, at least in this case, losing money on the investment side, we want to preserve things, shelter that, move to cash. And we have record numbers of cash that we've talked about on this show for quite a while. But the reason why we do this show is because I believe the news does a really good job of telling you headlines, but does a very poor job of getting into specific details of the headlines, which is I'm about to do. And they do an even worse job of giving you historical precedent, like, oh, here's the other 50 times in the history of the United States where this has happened.
Yeah.
And everything actually was pretty damn good, the next 6, 9, 12 months. So that's what we're here to do. This is how I control my emotions. My temperament is what Warren Buffett would call it, is I look at yes, this is the headline news information, but what's the underlying information that drove inflation?
Right.
And then more importantly, what does history have to say about it? So here we go. This is what we're not talking about, which is why I'm starting with this, right? I could go, the speech that Powell's getting ready to give. I could go geopolitical stuff, but I'm starting with the stuff that everybody just decided to skip over.
Yeah, and we completely left out MLB playoffs, the status of the Bengals. So let's just get right into it.
Here we go. So shelter is a component of the core CPI calculation. Shelter is 40% weighting, right? It takes that segment of CPI has the longest lag effect. Like we're just barely now starting to see signs of disinflation from a shelter standpoint. But the forward-looking indicators for things like, housing starts and so forth, they're all pointing towards massive disinflation on a shelter side of the inflation calculation. And it's obvious. You got 8%, 30-year mortgage rates now. I can go on and on, but I think everybody gets that. I think the Fed acknowledges that too, which is also important. So 40% of the core CPI inflation calculation comes from shelter. There is a subcomponent of shelter. It's called lodging away from home. It's hotels.
Okay.
So hotel inflation rose 4.21% for the month, or if you annualize that, it was a 51% spike in lodging away from home. So the question becomes, does anybody really think that hotel price increases will be a concern for the Fed needing to increase short-term interest rates? I would argue no, because the prior month, the same metric, lodging away from home, was negative 3.59%, or if you annualize that, negative 43% disinflation for lodging. So why the spike in 1 month? You can actually look into the Fed's data and it shows, or the government's data, and it shows you the majority of that spike came from the state of New York. So the question becomes, well, why is that? Well, there's a annual conference to General Assembly, UN General Assembly. They always get together, same time, same place in the state of New York. So I guess, all hotels kind of caught on to that fact and, they made a little bit more money for the month. But again, the question is, one, why did anybody not speak about this? Because if you actually look at just the hotel inflation in this report, that accounted for 0.1% of the 0.3% we saw in core inflation. Literally a third of the core inflation number came from lodging freaking away from home. And
that's amazing.
And if you look at it from that context, well, you can say clearly there's no reason for the Fed to increase rates because of this one blip in the data regarding hotel inflation.
Yeah.
And if that didn't happen, let's say you had, the August hotel inflation numbers was minus 3.5%. Now you get core inflation, you're like 0.2 or less, right?
Right.
That was not talked about at all. It's just, it came in line with expectations. Market like that. But if you deliver the actual information the way it actually is available for everybody to go find, but nobody's going to go freaking do the work to go, find, lodging away from home inflation. Let's go to look at that from month over month. Like, that's why I do this stuff. It is my job. That's why I want to do the podcast the way that we're doing it. I got a lot of great feedback from that. Customers truly like it. And it is different than what you're getting in the news. So I thought that was worth mentioning. I would be willing to bet this coffee mug that you didn't know that was in the data either.
I did not.
But doesn't that, when you look at it from that lens, completely different perspective.
Yeah, well, first, you just won back your own coffee mug. But no, you're right. I had no clue that was in there. And not only, when you hear came in line with expectation, that's way better than the other, with oh my God, this is worse, but it's not as good as, wow, we beat expectations. However, I think a little bit of, people watch the news because they're expecting to get those kind of detailed aspects of the data.
Yeah.
Like not just, hey, it's all good, don't worry about it, now go get scared, which is what the news has been doing.
I think so.
So, yeah, I would like to have known that, especially if it's an annualized, predictable kind of increase. Like, well, a huge amount of people from across the globe visit New York State this 1 year, and it actually is enough to show up on these economic registers.
Yeah, crazy.
Like that'd be something I'd want to know about, because then I'd be like, well,
Well, the reason why I wanted to know about it is because you saw interest rates across the entire yield curve, the 2-year, 5-year, 10-year, 30-year, all pretty much spiking to levels we haven't seen since 2007.
Yeah.
which has put a ton of pressure on all the major averages, the Dow, the NASDAQ, the S&P 500. Earnings have been nothing but extremely strong, so far. We got a ton of earnings data that's getting ready to come here, but what is preventing the market from rallying? Typically, October month is where you would see signs of rally into year end, because corporate earnings should be really, really good. But the major risk in the market is inflation and what the Fed's going to do with interest rates. And we're going to talk about that here in just a second. But we generally viewed this CPI print that I'm talking about, as positive, in line. And if you actually understand the data that drove the core inflation numbers, we think it's a really good thing for markets, to come here to finish out the year strong. So we also have to take a look at the last Fed meeting. You may recall that Fed Chair Powell spoke in September. He decided not to increase short-term interest rates, which is obviously good, but the tone of the message he presented was extremely hawkish.
Oh, yeah.
So at that time, the probabilities of a December rate increase spiked from about 40% to 55% post that Fed Chair conference. And we have remained in this 40 to 55% probability range until recently. So this is important, I think. Many Fed members have been making some pretty positive comments on the path of inflation. For example, here, Fed Governor Christopher Waller, who has been among the most vocal advocates for higher interest rates to fight inflation, meaning extremely hawkish. He had this to say, quote, price data seem to now be moving back towards the Fed's 2% target, with financial markets adding further credit tightening on its own, meaning that the 10-year yields that we're talking about being at historical highs going back to 2007 is doing some of the work for the Fed. So as the markets receive these, quote, dovish comments from Christopher Waller on inflation, probabilities of December rate increases fell from that 55% level down to about 25 to 30% range where it is right now. Now, we believe here at Shepherd Wealth Management that the next inflation number that we're going to get on November 15th will drop the probability for December rate hikes to near zero, close to zero, which is obviously a really, really good thing for equities. And that would also relieve this massive pressure that the yield curve is putting on the market. You would see yields actually fall under those circumstances, and that's where the rally point would happen. But the question is Fed Chair Powell at noon today going to acknowledge some of these things that are very clear to me in the data? And that's what has me waiting with extreme anxiousness right now, because literally the guy's going to move the market, one way or another in a big way here in the next 40 minutes.
I feel like he's just like got a picture of Paul Volcker like duct taped about 2 feet off the floor, and he's just doing like some serious push-ups in front of it, just living off of Red Bull and gummy
kind of like
worms.
Rocky, where he has the picture of Drago.
Yeah, and he's just like living off of Red Bull and gummy worms, being like, I'm so important. I am so important. And he doesn't even know what he's gonna do.
I wouldn't surprise me in the least.
If I had to guess, actually, I would say that he's going to give a bunch of mixed signals to where there'll be a slight, the market will pop and then it'll totally fall in one day and it'll be back to normal the next day.
That'd be bad too. If the market comes out of this, meeting that he has where he's doing a Q&A, and they're still confused about the answers like he gave, in the prior speech, which caused all kinds of volatility, then even after we got really good data, that would be a bad thing too. Confusion is bad, and saying that we're not winning this war on inflation to me would be asinine as well.
Yeah, like in anything other than we're cautiously optimistic. That's the lowest I'd like to see him go. Like,
that would be great.
There's no need to even be that. It'd be like, hey, we're seeing the lag effect kick in. Like, it's time to be hopeful now. And, obviously we'll do what we have to do if something pops off, but like, we're not expecting to.
Exactly. I don't
know how hard that would. Why is that so hard for him?
I don't know. It's extremely frustrating from a management perspective because I have to make decisions based on data. I can't get in the guy's head and try to guess what this person's going to do. I would assume what he would do is actually look at the data the way it's being presented, and maybe make some comments like, hey, this is an anomaly situation here with hotel inflation. So, and if that's not happening, then we have a lower than consensus expectation on that. We expect that to likely continue. And if it doesn't, we'll do what we have to do to win the war on inflation. But right now we're winning that war. That would be great. That would be actually the truth too. But I don't always get what I want either.
No.
In the other side of this, so I get a lot of questions, right? When interest rates are going up on the yield curve, people start to question, well, what is the value of the market? Is it different now? And obviously that's a legitimate question, because you use what we call risk-free rate, which is treasuries, as a discount rate for trying to value securities or the market. So I got those questions, and I took a look into this, and I posted this in the blog. So again, that's at shepherdwm.com. You can access this data as well. So although the technology sector has been the best performing sector year to date by a long shot, I do expect other sectors of the S&P to participate in a year-end rally, given how inexpensive they are relative to the average PE ratio on the S&P 500. And when you compare the market's PE ratio to something like the 10-year Treasury price to earnings ratio, we got some staggering differences here. So I don't think most people know this, and I know for sure it's not talked about in the news at all, because everybody's like, oh, the market's too expensive. Well, if you subtract out the seven, magnificent seven that some people like to call them, these big tech FANG names.
We're calling it Mang now.
Well, yeah, that's okay. Somebody tried to do that actually on CNBC, and I just don't think it stuck like FANG did. But anyway,
they didn't have me behind it. That's why.
You're probably right. But FANG, or the S&P 500 X FANG price to earnings ratio is about 17.8%, which is pretty close to historical averages on the S&P 500. I'm sorry, that's the S&P. The S&P 500 PE ratio as we stand right now, including FANG, is 17.8. If you take FANG out of the equation, S&P's forward PE ratio is 15.4, which is under the historical average of the S&P 500. So the market is not expensive, right? If you take out those big seven names. The FANG names themselves, so that basket of those big tech, seven names, the PE ratio right now is 27.2. So of course that's high relative to the S&P, but that's where the majority of the growth has come from. So they do deserve some sort of premium on their multiple because of all the growth that we see there. So from a historical perspective, the market is extremely inexpensive. That's why I noted that I do think that other sectors will start to participate in a year-end rally once we get some clarity from the Fed regarding what they will do with rates to fight the inflation war. Whether or not they feel like they need to be engaged or not will determine the outcome of the rest of this year, in my opinion. But if you actually compare the S&P 500 PE ratio of 17.8 to the forward price to earnings ratio of something like the U.S. 10-year Treasury, well, the U.S. 10-year Treasury's price to earnings ratio is 21.5. It's extremely expensive, right? So I think that rates are near peaking out from a PE multiple standpoint. Which means if they're peaking out, the next path for them is lower. But it's really just going to depend on what the Fed chair has to say about inflation and their either need or lack of need to increase rates further for the rest of this year. So I would argue that the market's actually way more attracted to be invested in from a valuation standpoint, even more so than something like the 10-year Treasury. So I don't think that anybody was looking at the data from that perspective, and that's a big reason why we wanted to share that with you all. So I know I've dropped a lot of knowledge on folks here in the first third of this particular podcast.
That's why they listen. That's why they listen.
This stuff was not talked about, and I cannot believe it.
It actually still shocks me. I mean, it seems like every episode of the Financial Shepherd podcast, we remind the viewers about the mass media, the news outlets, their place in delivering data. Yeah. And like their actual schemes and what they're going for, like how they structure their entertainment and how they want views. But it still shocks me every time you drop the data that they leave out. Because most people, including us, like here in the office, like always have those channels on. Yeah. And people feel like they're being informed by the news when in reality, they're leaving so much out. Yeah, that was to me, that's a huge... You have to know that to have a right perspective on the path of inflation, right? Yeah. And why they just stop at the headline is unbelievable to me. I don't know, but that's why we're in business, and that's why we have a job to do, which is what we're going to do. So shifting gears a little bit, obviously geopolitical risks. So a lot of questions about that from customers. It's not fun. Like, I'm a human being too. I have emotions. That's what make people who they are, and obviously, I would love some sort of peaceful resolution on the Ukraine front. Love to have that in Israel. Love to have that for everybody.
But when I answer the question of, well, what's our take as a firm on geopolitical risk? And I sometimes make things maybe too simplistic, but I think this is very true, and a very, very simple way to understand it is since the beginning of human beings being on this planet, right? We've had conflict with one another somewhere on this planet pretty much every day for eternity, right? So when you think about it from that perspective, you cannot diversify yourself away from geopolitical risk, right? You can't hide in cash. You can't hide in, obviously, securities. And why can't you hide in cash? Well, if there's geopolitical risk and it escalates to something like a World War III scenario, well, you're not going to care how much money you have or you don't have under those circumstances. So again, I don't take light of the situation at all, but the truth of the matter is human beings themselves have been in conflict with one another somewhere on this planet for pretty much all the years that we've been in existence. So like I say, you cannot diversify yourself away from geopolitical risk. We deal with that every single day when we wake up.
Yeah.
It's just a fact of life. So with that in mind, we also have to look at what history has to say under events of conflict. And although at the moment, it doesn't seem to really be affecting the U.S. markets, the stock markets per se, it's actually been historically a benefit for investors in the stock market during a conflict situation. The markets actually do fairly well because we have to make things, we have to ship things, all that sort of stuff. So I look at it from this is what I have to do for my job. This is what I have to do for my clients and investors. I wish we didn't have to deal with geopolitical risk, but it is what it is, and we look at from a historical lens like we look at everything else. So I certainly hope for resolution, but markets tend to do well, and right now we're at least not seeing a huge effect here on market sentiment here in the United States. I think if that were to escalate, clearly that's not going to be a good thing for sentiment, and short term definitely would not be a good thing for the market. But over a longer period of time, history would suggest otherwise. So that's my take on that. Certainly hope everything gets resolved in the fastest way possible with as least human casualties as possible. So that's our take on that. And the other thing too, those people over in Israel, they've had to fight for forever also, and they're still there in existence. So I think that they'll still be there when this is all said and done. Anyway, shifting gears, the retail sales number. So this was extremely important. I thought it was really awesome data, and I'm looking for right now to get the listeners here exactly what we're looking for here. So retail sales number came in this week. Consensus we're looking for 0.3%. We had retail sales at a whopping 0.7%. So way bigger retail sales than consensus expects. So what happened when we get this awesome data? By the way, 70% of the economy here in the United States is the consumer spending money. So when you have people with a job, which we do, unemployment rate being, under 4% still, which we'll talk about that here in just a second, that allows people to spend, which means generally when we get news like, hey, consumers are still spending and everybody has a job, that usually rallies markets. Why did it not rally markets? It actually rallied all the treasuries across the curve, 2s, 5s, 10s, and 30s. Why did those interest rates go up? Is because people are assuming that the Fed's going to have to continue to increase interest rates on the Fed funds rate because the consumer is still too strong. We have too many jobs, and if they continue to spend, that's going to potentially keep inflation high. I don't think people actually understand inflation, like how they calculate it at all, for the most part. And this is generally a really good thing for the economy. Like if you want sales for Q4 to be really good for the holiday season, consumers are going to need a job so they can spend money on retail stuff. But yet that was the market's taking good news as potentially bad news and what the Fed's going to do with interest rates. So that's the thing right now, unfortunately.
That is a thing. And like you, I'm completely vexed and baffled by that logic. I mean, everybody's got money. We're going to spend it. That's how that works. You're going to dump it into the market long term, and then you're going to spend it.
That's exactly right.
Especially with the shifts in consumer desires since the pandemic, away from smaller consumable goods towards larger experiences. People are going to shell out way more money in giant chunks to go on trips or see major concerts out of town.
Yeah.
And spend all the money in so many more places that they would, so many more areas of the economy than if they just like went to the mall and bought a shirt.
Yeah.
I don't get it.
When we look at this too, so August, so this is from FactSet. This data is coming from FactSet. August figures were revised higher as well. They went from 0.6 to 0.8. And when you strip away autos, fuel, sales rose by 0.6%. Economists were forecasting 0.2%. So the consumers got a job, they're spending their money. Here's Ted Roseman, industry analyst at Bankrate. Quote, despite low consumer sentiment, so investors are generally bearish, and numerous economic concerns, these reports don't indicate that a recession is near. I would completely agree with that. He goes on to say, quote, consumer spending remains remarkably resilient and is actually accelerating in discretionary categories such as dining, to your point, big ticket items such as new cars. So this is definitely not pointing towards recession. And to me, this is actually really, really encouraging news from a investment perspective, both short-term and long-term. People have a job, people spend money. That's a good thing for sales. It's a good thing for publicly traded companies and therefore the long-term investor. So again, I don't know why we're taking good news as bad news, but that's the reality of the situation. Is the consumers concerned with what the Fed is going to do with rates because they perceive a strong economy as potential inflation kicking back in and therefore the Fed being engaged. So again, everybody's trying to guess what this person's going to do. I get it. He's giving you a bunch of conflicting signals here, and we talked about that in our prior podcast. But if you let the numbers speak for themselves, it's pointing towards disinflation, which is less Fed engagement, which is lower interest rates coming around here. And if corporate earnings stay strong the way that they have been, I think you get a remarkable rally for the year end and potentially even beginning of next year.
That's what we're all hoping for.
Yeah, I mean, when we talk about the job market, initial jobless claims this morning. The market consensus was looking for 210,000 initial jobless claims, and we had a nice surprise. It came in at 198,000, so less than what consumers expected. Although, again, it's the same premise as what I just talked about here with retail sales, is investors are worried that a really strong and tight labor market is going to keep the Fed engaged and potentially increasing rates. So again, more people have a job.
It's what we want. Everybody wants that. Yeah.
Like, who doesn't want to hear that news? Like, who would want to wake up and be like, oh, crap, we have, we thought only 210,000 people would be on initial jobless claims, but we have 500,000. Like, how could that possibly be good news?
Yeah.
You almost have to laugh about it.
Well, we've been laughing for 2 years now.
I would like to actually laugh tears of joy today at noon.
Yeah.
If again, Chair Powell can actually be honest and not give a conflicting signal here on the data as it is actually, being available for everybody to look at if they care to look at it.
Yeah, I'd like the laughter to come from the cork of a whiskey bottle as the SWN team cheers, we're out of this hellish landscape that we've been in now
no doubt, man. I got it on ice. I'm waiting for it to be, just carted in here.
Yeah. Oh, I can't wait either.
We do have Beige Book news to go over real quick.
Ooh.
Beige Book is extremely riveting information here.
The khaki of the economic world.
What it's the Fed's regular survey on the economy. This is covering the 6 weeks leading up to October 6th. It was prepared ahead of the Fed's next meeting, which will be October 31st and November 1st. We'll get the actual announcement on what they're going to do with rates. So that's coming up here. So we got, this is again from the Scott Anderson of Bank of West. Quote, this report should give the Doves some additional ammunition in their arguments for the Fed to pause their rate hikes one more time in November. So the question's really about December, like I talked about. The probability of a rate hike by the Fed in November is next to zero. So the market's not expecting them to increase rates on November 1st at all. It would be extremely negative for stocks if he, decided to increase rates when the market's not expecting it. So clearly, I don't think that he's going to do that on November 1st. We get the next CPI print on the 15th. That'll be very key to what happens in December. Of course, our view is you're seeing the probabilities of a December hike pretty much stay right where it is right now in this 25 to 30% range. And I don't think that's going to change much at all until we get that next inflation print on the 15th. But it could change today, like short term, again, based on what Jerry's got to say, here at noon. But the Fed itself sees a stable economy, slightly weaker due to the fact that they have, what they view or some view as sufficiently restrictive on the Fed funds rate. So that increasing of interest rates has slowed the economy down somewhat in some places, but we overall see a stable, slightly less growthy, if you will, economy coming from the Beige Book. So all in all, good information as well. And most parts of the country, quote, indicate little to no change in economic activity since September. So their view on the markets really hasn't changed all that much. And of course, we just went over how tight the labor market is currently. So those are all the major headline news information. One that didn't get reported at all, when we got that last inflation print. But that's kind of all the information in a nutshell, if you will, leading up to today at noon's, very important meeting that the Fed Chair Powell will be presenting or taking questions and answering those questions in New York. So we'll be watching very closely. So those are all the highlight news we got for the podcast. We got any updates we need to share with the folks here?
No. Everything's moving smoothly. We've talked about a couple times, previous episodes where we're transitioning. We're continuing to take advantage of all the opportunities that YouTube Live gives us. And, we know on the back end of the podcast that we're having success with that. So as soon as we can finish all of our beta and get all the tech issues worked out, we're going to be doing a lot more remote live streaming, but that won't affect the scheduling or the customers of Shepherd Wealth Management or just the general viewership's ability to contact you with their questions. So it's just going to free us up to not have to necessarily be in a studio location all the time and maybe even be able to engage with the audience more with live shows.
Yeah. No doubt. So we'd love to get your questions. These are a lot of really important topics. I'm getting individual investor questions, but those that are liking the show, getting something out of it, you can actually ask those questions right on the YouTube channel itself. Yeah. You can leave comments also. We'll try to get back to that. And you can just reach out directly, 513-630-2664. Call, text anytime. Be happy to take your questions and address them. And certainly would love any positive feedback, those that are enjoying the show, getting something out of it. I know our clients are really enjoying it. We're doing our quarterly reviews right now, so we sit down with every customer every single 3 months. And obviously there are clear goals that each customer has, so we're kind of holding ourselves accountable to meet those goals. We're either going to be on pace, ahead of pace, or behind pace. We go over all that stuff with the customer. And the great news is, on average, year to date, so our average customer, we're positive about 24%, which means some are doing way better than that. Some are doing, not as good as that, but the overall market itself on the S&P is positive roughly 13%. So clearly quite a bit of difference in outperformance. What makes us so proud about the performance itself, other than meeting, the needs and goals of individual investors, which is the primary job here, serving them, is everybody at the beginning of this year said that this was going to be a recession for sure. Sky's going to be falling. The Fed increased rates over 500 basis points in 6 months, tightest and fastest that they've ever done something like that. And I understood all the headline news. We talked about the headline news, but then we looked at the historical data and evidence, and we actually wrote a newsletter and did a podcast on this right at the beginning of the year and said, this is our case for a double-digit performing type of year in the broader markets. And we laid out specific sectors, technology and industrials being our two primary overweight sectors we favored the most. And that is the most rewarding part for me, is because if everyone was right and we actually had this recessionary event in 2023 and the sky did fall, with the last two freaking places you want to be putting investor dollars to work is tech and industrials.
Yeah.
During recession, those two things get absolutely destroyed big time. Thankfully, we don't allow our emotions to get out of control with the headline news information. And this is why we spend so much time understanding human beings and what they've done historically over similar events. That's how we build, an asset allocation for any potential customer, which makes it unique in that way. It is goal driven, right? I got to take your risk tolerance into consideration, or how much income you think you need. or how much growth that you want to potentially receive on average over time. But the one thing that we can control, two things we can control, is our asset allocation, which is going to describe 94% of the variability of performance over any period of time you want to look at. And that's great news for the individual investor because you can, in fact, control your asset allocation. And the other thing that you can control is your temperament. Like, how do you make decisions under potential stressful circumstances? So building that allocation that way, the only way that we got to that allocation was based on historical precedents.
Yeah.
Right. That's what made me extremely happy in going through these results with customers during this quarter, is because everybody else, that quote unquote smart money made a pretty strong and potentially compelling case to some people that just kind of focus on the headline news. You never would have got these kind of returns. If you were positioned the way that they thought you should be positioned, you would have all of the money or most of the money overweighted in things like healthcare and staples and utilities. Those are the worst performing sectors by a long shot, this year. And some people were so fearful, they just decided to not participate. $5.6 trillion sitting in cash. I mean, they could have not hired Shepherd Wealth Management. They could have just bought the S&P 500 for next to nothing in any account anywhere and just sat there and did nothing all year long, and they'd be wealthier by about 13% or so.
Yeah.
Right? But all those people missed out on the gains of the market this year. So when we see all this negative headline news and the market's, going down over the last 2.5 months due to a lot of the headline risk and uncertainty about what the Fed's going to do, all of those people are just saying, yeah, I told you so. But eventually, once we get all this data between now and November 15th, remember, we got all corporate earnings announcements happening that we didn't have during, the September month at all. Only thing that we had to do is worry about all the stuff to worry about. You're going to have a Fed speak today at noon. You're going to have the Fed meeting on November 1st. They'll find out about the official path of rates, all kinds of jobs data, and the actual next CPI print on November 15th. So within literally the next month, I think we'll have all the information that we need to know to have a clear understanding of what's going to likely happen with the Fed, interest rates, and therefore the market, in my opinion. So we're talking about how to go about rebalancing now. So all of these gains, the question is, when should we do it and how much should we rebalance by? Like, how much of the gains should we take off the table away from the market and do something different with it to preserve wealth going into what could potentially be a volatile year with an election year? Now, I'll have a lot to say about election years as we get closer to the end of this year. So stay tuned to that. We try to drop these, podcasts on you about every 2 weeks.
Yeah.
We've been pretty consistent with that. So we'll try to do that and share all that data with you all. But really between now and November 15th is going to, for me, get the data necessary to determine how much to rebalance and when to do it. And that's the conversation that we're having fluidly and live with our customers. So it's been a great pleasure to deliver this podcast today. I know that we definitely got into some things that you did not get anywhere else because you have a hard time finding this somewhere else. But thankfully, you're a Shepherd Wealth Management podcast listener or viewer, I guess, if you're watching on YouTube Live, which is awesome. You can go to our website, shepherdwm.com. It takes you right to the YouTube page. It takes you right to the Spotify page. You can download the Audible while you're working out, walking the dog, whatever. And you might have something else to talk about at the, gatherings coming up here for holidays, getting the one-up, I guess, on your friends and family by sharing data that they're not going to really get probably anywhere else.
Yeah, some hot financial goss to spread around the water cooler.
That's exactly right.
So Walter wants to think he knows what he's talking about because he was up all night watching the MSNBC.
That's right. That's exactly what I'm hoping to give you guys, a little bit of extra data. So appreciate it. Definitely we'll be doing this again in a couple weeks. Hope you guys have a great rest of your day. And we got 15 minutes for Jerome Powell to talk here. So I'm going to be signing off now so I can catch what he has to say. Take care.